Hey, what's happening, guys? Dan Darrow from Options in Play. Today, I'm going to go over what option risk reversal is, okay? I'm sure you may have heard this, so if you've been following options or if you're an options trader, you probably have heard people talk about risk reversals, all right? Um, Today, I'm going to specifically talk about the bull side, so the bullish risk reversal, and this will not include positions that have equity, okay? Because sometimes people will say a risk reversal, a bearish risk reversal, but it'll be tied to stock, and that is actually something different, almost called a collar. So specifically, what I'm going to talk about are bullish risk reversals that don't include an equity position, okay? Now, fundamentally, a risk reversal is a more complex option strategy. Okay, it requires multiple legs, so two legs in this case, and it's one involves a long option, the other one involves a short option. Okay, and really, like the idea behind a risk reversal is that again, I'm only going to be talking about the bullish risk reversal in this case. Is that a trader is bullish on the stock, so that they think that a stock could go up, and they're looking for a way to offset the premium of the calls. So how to finance the upside potential, okay? And um, whereas, like, just buying, so I have the chart of IBM up here, and just buying the call on IBM, you got to lay out the premium, right? So very, very simple. Like if you buy a call, your risk is the price paid. But sometimes maybe you want a longer term position, right? You think IBM, beating down stock, right? Beating down stock maybe doesn't have a whole lot of room lower, but at the same time, not sure how long it's going to take to really rally, right? I mean, it's been holding this 130 for months, but it also hasn't really gone up very much recently, right? So somebody will say like, yes, I think it could go up, but I'm not sure how long. So they will go with a longer term position, right? And when you go out with the longer term call position, typically they're going to cost more, right? So if somebody was saying like, okay, I want to get in this, but the options are very expensive. Now, what a risk reversal is, it's a combination of long call. So I'll go over contracts in a second, but it's a combination of a long call, and the trader will finance that by selling a short put. So it's a credit put, so they're collecting the premium on the put, and then they're using that to purchase a call. Okay, now the thing is, like, your risk is going to be different because if the stock were to drop, so if IBM were to drop, then and it dropped below your strike price, then you are on the hook for that short put, right? So theoretically, you have to be willing to own the stock under that price because the put, if it goes into the money, then you could theoretically have to deliver the shares, right? So people say, I'm comfortable owning under a certain amount, right? So that's what they say, like if you sold the put, they're comfortable owning that under that amount. Now, normally traders, when they put on a risk reversal, they want like the net of the position to be little to none. Okay, so they're looking at the risk reversal as an opportunity to get finance that upside for basically little or no cost. Okay, so again, focus on this 130 level on IBM. Right, you can see that 130 been a long-term level of support. So say you think, I don't think IBM is going to go below this over the next 6 months, right? But I also am not sure how long it's going to take to go up, and it might not go up that much, right? So I want a lower way to get involved with this, right? So up here you can see I have the July options, right? And see the 130 strike puts right here. These are the 130 strike puts. They're trading for between 515 and 530. So say like 525, right? Look at the 140 calls, 515 to 535, right? So basically the exact same, but more or less the exact same net premium, right? So a bullish risk reversal on an IBM July option right now, a trader may look to sell the 130 put, right? Collect the 520, and then use that to buy a 140 call for basically 520. So in theory, the trade only costs them the commissions, right? Because it's basically like a net even. Obviously, commissions, you got to pay for the commissions, right? Now, if IBM were to go above 140, then basically like the trade was put on for basically like a flat debit. So anything above 140, plus commissions, and the trade starts to move into the money, right? So basically, if you had just bought the call, it would have to get probably materially above 140 for that option to gain value because you laid out 520. But with the bullish risk reversal, the net of the position was basically even because you sold this for 520 and you used the 520 to buy the call. So basically, once it started to get above 140, the position would be increasing in value. At the same time, if something happened and IBM started to drop substantially below 130, then you're on the hook because you sold the put. So as the stock starts to drop below 130, you are on the hook for the losses below 130, right? So you can see it's kind of like a double bullish strategy in the sense that people are willing to sell the put to finance the upside call instead of just buying an upside call, right? So again, this is just a bullish scenario because some people will talk about bearish risk reversals, and it's basically the opposite. Or if you combine this strategy with stock, it's going to be called like an option collar. Okay, so what I just talked about today is just specifically for like the bull side, a bullish risk reversal. But it's just a good example of what people mean when they talk about risk reversals, and you can apply it to like the bear side too. I mean, you just kind of flip around the strategy. So it'll be a short call and a long put, right? Instead of a long call and a short put for the bullish. All right. So I hope this explains things to you. Goes over it a little bit more. Went over a little bit more in depth, kind of like walk through that because some people may not be familiar. But it's a relatively straightforward idea. It's a little bit more complex from like an option trading point of view, but relatively straightforward idea. All right. So if you like these videos and you're looking for more information on options education or options trading, trade ideas, please follow up with the link in the description of the video for more information on options to play. All right? Have a great night, and I will talk to you all soon.